That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Macro Talk News founder Hope King, as well as Yahoo Finance's Jared Blikre, join us here to break down the moves. So Jared, let's start with you here on the close, and it looks like we're seeing losses across the board.
Yes, we lost some steam, and I'll show you a few charts here on the Wi-Fi Interactive. First up, the Dow, basically where it was an hour ago, down about 200 points. We can see it just made a new low on the day a few minutes ago, but bounced back, relatively speaking. Then the Nasdaq really slid to new lows and did not bounce back that much. So we're seeing a loss there of about 1/3 of 1% on the day. Similar for the S&P 500, that's down 1/4%. And let's take a look at the small caps, also kind of similar there, down about 13 basis points, nothing to write home about. And let's skip to the sector action. I thought this was interesting today. Communication services and consumer discretionary up 0.5% and 1/4% respectively, but then also healthcare just barely in the green there. That's XLV. To the downside, we got energy, that's XLE, trading down about 0.8%, and then tech and real estate also down more than 0.5%. And if we take a look inside the Nasdaq 100, really a red board for the mega caps except Tesla. That finished the day up 2.84%, but it also lost some steam in the final minutes there. And we can also take a look inside tech. I want to just do this quickly because I was showing the difference between semiconductors and software before. This board was a lot more green just an hour ago. We're seeing a lot more of these issues in the red like NVIDIA, and you can see the decline here that we saw at the end of the day. Flipping over to software, we do see a lot more red there and a more dark red. So to be fair, software maybe took it on the chin a little bit more. Salesforce down 3%, Intuit down 5%, Workday, Atlassian, HubSpot, all these down 3, 4, 5, 6%. Oracle, though, up 1.15%. That's got to be a new 2-decade high for that stock. And let me look at the Dow here, and I'll finish on the transports. We do see some green in some of the staples like Walmart, also some of the financials like JP Morgan, and as I said, healthcare finished in the green. So we got J&J and United Health both green. But taking a look at the transports, which have been lagging recently, you take out Uber there, which is in the upper left, up 1.14%. Not a lot of green here. So the companies that are shipping this stuff suffering more than the companies that are making this stuff. Back to you.
Thanks, Jared. And Hope, I want to get your thoughts on the latest moves here because it sort of feels like markets are sort of muddying through today until we get some more clarity on the economic front tomorrow.
Yeah, I think they're in a holding pattern right now. I think there's so much data coming out this week, starting with CPI. Tomorrow we have retail sales at the end of the week, including producer price index, which comes before that, which is wholesale inflation. So I think for Monday, for today, the big story has been NVIDIA and AMD striking that deal to get more advanced chips to be sold in China, that deal with President Trump, and also the tariffs for China being delayed a little bit. So I think for right now, this seems like a pretty flat market, generally speaking. Maybe you're selling a little bit, maybe into the week later on, if we don't see the pressures on inflation to be as significant as most people are fearing.
Right, and this is the start of really a big economic data week. We'll also be seeing retail sales later this week. So when it comes to the inflation front, when it comes to the struggles that we've been talking about with the Fed, how important do you think this print is when we look ahead to that possible September rate cut?
I mean, I think it's definitely important, but it's one of many. And we've already seen PCE, which is the Fed's preferred inflation gauge, tick up last month. So we're seeing hints of inflation finally coming into the picture. We've been waiting for the data to show the pressures of the tariffs. And I think one of the biggest concerns that analysts have around tariffs and the inflation pressures from tariffs is whether or not companies are going to pass it on to consumers, or if they're also going to maybe cut jobs if they do not pass it on. And if they start cutting jobs, you know that if people are losing their jobs, they're not going out to buy things, they're not going to be able to support the economy in that way. I think that's the bigger concern right now for a lot of people.
And I want to bring in another guest for more of the market action of the trading day, Jim Schmigel from SEI. He is a CIO there. So Jim, a lot of news that we got today, and it trickled throughout the day, but I want to start with where we're at with the S&P 500. We are currently trading at record highs. Just earlier this morning, we saw Citi boost its price target to 6,600, and they cited earnings potential, not just the earnings that we've seen in this latest quarter, but also looking ahead to 2025, 2026. Why have earnings been so resilient in the face of all of these economic uncertainties?
Thanks for having me. It's definitely a great question. There's two things with earnings which we find really having ourselves have a glass half full kind of outlook for the market right now. It's not just that they've been so strong, but they've also been relatively broad. Over 80% of the S&P 500 are showing kind of some earnings momentum over the last 3 months. That's a really, really good sign for us because we do have kind of this little bit of a divergence going on, particularly in U.S. markets, where we still have the Mag 7, particularly NVIDIA now hitting over 8% market cap within the S&P, the highest in recent memory of any kind of single name. But we have a little bit of this bubbling up of earnings kind of happening kind of below the surface with some financials, some industrial. So there's still that concentration, that big AI theme, which is dominating everything. We saw a lot of the CapEx spend of the recent announcements from Microsoft, from Meta, kind of dominating the headlines. But really, the trend is your friend. That's kind of where we've been. We have, again, a positive outlook, but mostly because we do see some broadening out of earnings, some early signs of that bubbling up in the market.
And that's been fueling a lot of the records that we've seen. But you brought up tech, AI, and Bank of America. They released their latest global fund manager survey this morning, and it shows that long Mag 7 is still the most crowded trade, but 55% say that AI is boosting productivity. Most managers not seeing a bubble yet. How do you interpret this? Are investors too optimistic, or is this justified given the tech sector's solid fundamentals?
Well, the B of A is exactly correct. I mean, this is the theme of all themes right now. Everything trades on AI for the most part. You know, there's even a little bit of divergence between, you know, what we do see is some softening economic data, particularly on the employment side, obviously, with the recent release, and just the absolute resilience in the tech market. And one does begin to wonder, is the S&P and U.S. markets kind of separating a little bit from the economy because of the dominance of AI? But to your point specifically, I mean, let's roll back a little bit and think about that the latest Microsoft release. I mean, you know, Microsoft announced that about 30% of all coding is kind of being done now by AI. That's an amazing number. So this isn't necessarily something that we're looking really far into the future and hoping for some efficiencies to manifest themselves. We are seeing the impact of it right now. So it is definitely a dominant theme, but it's one that we think has legs and will be continuing really for the rest of 2025.
And there's been a lot of talk about stock market euphoria, increased speculative trading. It doesn't seem like you think the stock market is too frothy at this point, but what would be the signs that you're looking out for when it comes to maybe, okay, there is some concern in the market?
I think anytime you get the concentration that we have, there is some concern. So a lot of the messages that we've been giving to our investors recently have been, look, if you're very, very passive oriented, particularly in the US, you may want to think about some alternative approaches because the idiosyncratic risk that we see in the United States today is unlike at any time in the past. The tech bubble, keep in mind, I mean, the biggest individual name during the tech bubble approached about 4%. And as I mentioned a little earlier, NVIDIA's over double that at this stage of the game. So, you know, the amount of idiosyncratic risk does warrant maybe a different approach. Make sure you're global in nature. Consider active management, even in the United States, or at the very least, some alternative beta approaches. We like value right now in the States. We like momentum, a little bit less so on quality, but there are ways where you can still get a large majority of that kind of broader beta of the S&P 500 without taking on all of the idiosyncratic risk. We do think that diversification remains an important factor for investors.
And related to that, given the volatility that we've seen, it almost feels like traders are hoping for some dips to buy. Do you expect investors to keep buying these dips? And what's fueling that mentality right now, especially as this has mostly been driven by retail traders?
You're exactly right. I mean, obviously the Liberation Day dip buying. If you dipped your toe in the pool back then, you have been very, very well rewarded. NVIDIA up 100% since April 8th, just as an example. So definitely there is a little bit of this just kind of absolute momentum where people are on the sidelines. That fear of missing out is still a factor. The dominance of shorter term trading in the market. I mean, we've seen this, whether it's the retail trading, whether it's the intraday options. The market overall does feel much of a shorter term play than it has been in the past. We don't feel as though we're discounting cash flows 10 years in the future anymore. We feel like more discounted cash flows 10 minutes in the future. So that is a characteristic of the market that, of course, we think is there and is present until it isn't. So it's very hard to call. But it does suggest that the volatility of the overall market should stay somewhat elevated in the near term, and that is our expectation. The answer for the end investor? Again, diversification. Make sure you're diversified in your U.S. equity holdings in particular.
And Jim, you knew this question was coming, but the Federal Reserve, right? There's a lot of talk whether or not they're going to cut in September, how many cuts we could see this year. Does the market care if we get 1, 2, 3, or maybe even no cuts this year?
I think that's a great question, Allie, and it gets back to what I said earlier. Is the U.S. market in particular becoming so disconnected from the underlying economy that maybe it really doesn't matter all that much? Quite frankly, we think it still, of course, does matter, but maybe not as much as it has in the past, right? We did have that kind of major revision in NFP that caused a little bit of some gyrations in the market. But, tomorrow's, as Hope pointed out, tomorrow's is going to be a very, very important print. Even if we get kind of a at expectation, which is about 0.3% on CPI, we do think September is a go. But I think that's a great question that all of us are kind of asking ourselves right now, is that does it matter all that much? I think it matters, quite frankly, if we get no cuts between now and the end of the year. Whether we get 2 or more, probably not all that much.
Yeah, and there certainly is more conviction that we will be seeing that September rate cut. Jim, thanks so much. We'll see what happens tomorrow.
Thanks, Allie.
Well, coming up on Market Domination, we're breaking down the differences between headline and core CPI. That's ahead of Tuesday's release. Stay tuned.
President Trump has been a loud critic of government data, most recently shocking investors and policymakers when he fired the Bureau of Labor Statistics Commissioner. Trump making that decision following his claims that the weaker than expected July jobs report was, quote, rigged. But how exactly are these economic data points collected? Let's get over to Yahoo Finance's Jared Blikre, who has a breakdown.
Yes, Josh, the political fire is hot, but the numbers underneath it are what really matters. So let's check them out and look at these bars, which was what first was reported way back in May. And when that was released, it was 158,000 new jobs. And in June, we saw an increase of 140,000. That you can see on your screen in those big green bars. But when the July numbers dropped, and they weren't that great themselves, those 2 prior months shrunk dramatically to 19,000 and 14,000. That is 250,000 jobs gone, the biggest 2-month downward shift outside of a recession since 1968. But remember, that first number is basically a rough draft, and history says it can miss by about 130,000 either way. So big swings, they happen. And the bottom line is 3-month hiring is now at a modest 35,000 per month, and this is not what we consider boom times. Now let's tour the data factories. First up, we have the Bureau of Labor Statistics, It cranks out jobs, inflation, and vacancy numbers with a turnaround of about a few weeks. We're going to dive into the particulars here in a minute. Next up, we have the Census Bureau. Think retail sales, housing starts, factory orders. It has the same fast clock measured in weeks. And then we have the Bureau of Economic Analysis, or BEA. That's where you find gross domestic product, consumer spending, and a different look at inflation. Now, the star of today's show is the Employment Situation Report. It's a monthly snapshot of payrolls, wages, and joblessness. It's based on the week that includes the 12th of the month, and it usually drops the first Friday of the month. The BLS uses 2 different surveys to put this report together. One is called the Household Survey, which, as you might guess, surveys households across America. It comes from calls and online forums to about 60,000 families. Who's working? Who's looking? Who's sitting out? The other half comes from a survey of businesses that hire the workers. That's called the Establishment Survey. And it comes from emails and web forms sent to roughly 120,000 employers. That's where the headline payroll figure comes from. That's the source of all this recent controversy. The problem is fewer forms are coming back. Over the last decade, and this chart shows this, household responses slid from about 88% to 68%, and business responses, they tumbled from 61 to 43%. And you can see in that chart that it was really the pandemic that slowed the response rate, and things have just not bounced back. Less input on day one means a bigger cleanup crew later, and that's why revisions can look jarring, as they are right now. On top of the monthly tweaks, guess what? Every February, that brings what's called the benchmark revision. Payrolls get matched to tax records, and this year it erased nearly 600,000 jobs from 2024. But the original benchmark revision was even higher, 818,000, which was another data point that President Trump recently measured. So if you're following along here, even the revisions get revised. Now, at the last Federal Reserve press conference, Fed Chair Jerome Powell put it this way: government data is the gold standard in the U.S. We need it to be good and we need it to be reliable. And that gold standard now sits with a new acting commissioner at the BLS and his team of statisticians. The next jobs report drops Friday, September 5th, and we're going to be sitting here on pins and needles for the next draft of the truth.
The Consumer Price Index, or CPI, comes with two key numbers: headline CPI and core CPI. CPI measures how much prices are changing each month for a basket of goods and services we all pay for. That's everything from eggs and milk to cars, medical care, and even sporting goods. Headline CPI is the overall inflation rate for that full basket, whereas core CPI is that same measure, but it strips out food and energy. Those are two categories most prone to big and unpredictable swings. So why remove them at all? Well, things like weather and geopolitics can send those prices soaring or falling in a way that can distort the broader trend. A drought can push food prices higher. A conflict in a major oil-producing region can disrupt supply and send gas prices spiking. That's why the Federal Reserve often puts more weight on the core reading. It gives a clearer picture of underlying price pressures. The same idea applies to another key inflation gauge, the Personal Consumption Expenditures Price Index, or PCE. That tracks what consumers are actually spending. It's the Fed's preferred measure when setting monetary policy, and just like CPI, it comes in both headline and core versions. The core PCE removes those volatile food and energy prices so policymakers can get a better read on long-term inflation trends. And Hope King is still with me, and we're going to be chatting a little bit more when it comes to core versus headline. And tomorrow, just parsing through a lot of this commentary from economists, it seems like core goods is going to be the big focus of this print.
Yeah, it will be. And I think one of the things that I think is very challenging in this environment is when you look at the data, some of it looks pretty decent. We haven't seen the high pressures of tariffs on prices, but we know that at the supermarket, in stores, consumers are really feeling it, especially those on the lower income side of these households. And I think that's also one of the challenges that the Fed has to balance, is whether or not we're looking at this data in the right way. There's a lot of nuance underlying all of the data. And if you look at some of the most staggering analysis around what the economy is actually doing right now, what's driving the economy, it's really the high income consumers. I asked a lot of economists this, why do retail sales look so good when the sentiment always seems so bad? And that's because when you look at the data is being driven by people who can actually afford the price increases, who are still spending. And the sentiment data is also showing everybody else who is, who are really, really struggling. And I think that's why the labor market is a much better picture right now of what the economy is actually going through, because if you have worries about your jobs, again, you're not going to be able to go out and pay and buy things and fuel the economy.
Yeah, this bifurcated U.S. consumer has been super interesting to me. And I think we're hearing that in earnings calls. You can kind of read through the tea leaves for some of these companies. And the ones that are most exposed to that lower income consumer, they're not doing as well as others that maybe have more of an exposure to those higher income consumers. And we do know for now that a lot of companies are absorbing as many costs as they can, but that's the big question mark, right? At what point is that going to be unsustainable? And in June, we did see categories like apparel, footwear, and furniture edge higher when it comes to those core goods prices. It's likely we're going to see that again for July, but the full impact may not show up until later this year, maybe even 2026. So to me, I feel like if you're the Fed, it must be really hard to gauge these near-term trends when it comes to inflation.
And that's why they want long-term data, right? They are always saying that they need more data to show that the evidence of these trends lasting and to be able to forecast. And that's also why, in some ways, watching earnings reports is a much clearer picture of what the economy actually looks like at the atomic level. You look at P&G, which now is saying that they've got price increases set for about a quarter of its items in the next few months. I mean, that is going to impact a lot more consumers than maybe an Adidas, which says that may have to increase prices in the U.S., or even an Hermes, which says that if it increases prices, they're actually not seeing their customers back away because those customers are able to afford it. So I think the challenge with these aggregated numbers is, on the whole, things look okay, but it is really important to go and look at every single data point underneath, whether it's sector or these companies that actually represent their sectors.
Right. Look at the data in aggregate, look at the earnings calls, the commentary, because it's very obvious that you can't just look at one piece of data. You can even look at the labor market report, right? We had significant downward revisions there, but the earnings calls, maybe that was hinting at some of that pain to come.
Exactly. Yeah. And I think with the labor market too, you're seeing a lot of sectors like healthcare adding jobs. That's fueling the growth, whereas many other sectors, mining, for example, construction, they're shedding jobs. And so if you only look at the top line, you're missing that bigger picture of what are the two main sectors actually driving it, which is, healthcare, social services, leisure, in that services category.
Yeah, healthcare just a continuous leader on the jobs front. But when that starts to weaken a bit, maybe we see that bleed through there.
Potentially, for sure.
And well, Hope, thank you so much for joining us for the last hour. I really appreciate it. And time now for What to Watch Tuesday, August 12th. Starting off on the economy, we'll get a key read on inflation Tuesday with the Consumer Price Index. Economists expect headline CPI to ease slightly to 0.2% for the month, while core CPI, which strips out food and energy, that's expected to tick up to 0.3%. Those numbers will give the Fed more clues as it maps out its next move on interest rates. And speaking of the Fed, we'll also hear from Richmond Fed President Tom Barkin and Kansas City Fed President Jeffrey Schmidt. This follows President Trump's post on Truth Social last week, announcing his pick of Stephen Miran, the current Council of Economic Advisors chairman, to fill the seat of Fed Governor Adriana Kugler. And turning to earnings, more results are on deck tomorrow from Circle, CoreWeave, and Kava. CoreWeave will report second quarter results after the closing bell, with analysts expecting solid orders for the cloud computing company, fueled by increased infrastructure spending from major AI players like Microsoft, Google, and OpenAI. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.